Gruyere has commenced production. We're pleased to inform you that we've achieved practical completion at the Gruyere process plant. What does that mean in essence? It's a technical construction term. In essence, it means we've achieved 96 hours uninterrupted through the entire value chain of the process plant. So the crusher, the SAG mill, ball mill, the elution circuit, the gravity circuit are all functioning steady state for 96 hours. That's really great news for us. That was achieved on the 10th of August. And so now we're in the process of ramping up that plant over the balance of the year. And as we've mentioned, we're giving a range of production because obviously with all ramp-ups, it's a large process facility. It's over 8 million tons a year. That's large in the scheme of process plants. You might get hiccups along the way. So we're saying that we should be able to ramp that up over the balance of the year. Bear in mind, over the long term, Gruyere is a project, as the joint venture announced in a recent joint release, that this is a 300,000 ounce a year mine with long-term costs of about 1,025 Australian dollars an ounce, at least with 11, 12 years to start with. And then, of course, there's potential on the joint venture property and, of course, at the mine itself to look for potential to add to that over time. So really a great addition to the group in line with the strategy of adding life at lower cost so that we can be defensive in the face of volatility in the gold price. And now let's talk about the gold price briefly. We've seen the gold price come up. Has it gone too quick, too far too quick? Who knows? It may be volatile in the future. Nice to have it for now, but we're not putting our store on a higher gold price. We'll keep discipline in the business. We are still targeting to achieve a 15% margin at a $1,200 US gold price, at a $1,600 Australian gold price, and a 550,000 Rand per kilogram South African price. And I think, as you can see, those prices on a relative basis to a spot are still some distance away from where we are today, which is good. Let's keep that flexibility, that cushion on our operations. Demand continues to track ahead of plan. So we're on track to really get to the heart of the ore body around about Q2 next year. That's really the big prize for us, is to open up the heart of the ore body and get in there. South Deep, after a very painful and time-consuming restructuring process that included a 45-day strike, a difficult Q1 as we had to recalibrate the mine post that strike, which was only concluded just before Christmas. So really in Q1 we had to take around about 20 to 30 pieces of gear out of commission, drill rigs, loaders and trucks. We had to say goodbye to a third of our workforce. We had to obviously recalibrate all of the logistics and consumables. We shut down, remember, 87-1 West and 87-2 West. We suspended the new mine development at the bottom of the mine, and we had to turn South Shaft into essentially a services shaft, not a fully fledged operating shaft. A lot of things we had to do. That took the bulk of Q1 to get going. But in Q2, we've got to a better position, to the point where production is up almost 70% on the first quarter. Costs have come down to about 590,000 Rand a kilogram, and we've made a modest cash flow contribution of 71 million Rand for the quarter. Bottom line, that is, after paying all of the bills. One swallow doesn't make a summer. I told the staff this morning when we did this abridged presentation to them. And certainly Martin, Priest and myself are very sober about this early achievement. We need to build on it, and we need to show that South Deep can actually achieve its goals. That said, where we are today, having produced about 2.8 tons of gold for the first 6 months, we're on track to achieve our 6-ton gold target, bearing in mind Q2 was about 1.8 tons of gold.